Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, and regulatory landscape and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site, we have Andy Baehr, Head of Product and Research at CoinDesk Indices, Eran Barak, CEO of Midnight, and Nauman Sheikh. He is the Head of Protocol Treasury Management and Derivatives Trading at Wave Digital Assets. We're here to discuss institutional shifts beyond Bitcoin if regulatory tailwinds continue to strengthen. It is great to have all of you with us. Andy, let's kick it off as usual with an overview of what you're seeing in the index space as it relates to Bitcoin and how it's performing and what's been a more broader volatility environment, not just specific to what we're seeing in digital assets.
It's been a real test, right? Markets have been fragile. We actually think it's been a really positive week for crypto assets in the last couple of weeks, given how fragile and unhedgeable the equity markets have been. The fact that Bitcoin has held on as a sort of a tariffless and sort of stateless asset. Even the few times when Bitcoin's price started to suffer, it was really kind of perpetual futures liquidations, which were creating those temporary kind of candle wicks coming down. But other than that, hanging out in the mid 80s has been really strong. CoinDesk 20 has performed similarly up, high single digits last year, so decent participation. So between the solidity and the steadiness and the relatively low volatility, plus those Michigan numbers last Friday where you saw consumers predicting one-year inflation highest since 1981. So I remember what the hit songs were. This was Dallas Dynasty, Dukes of Hazzard, Let's Get Physical. Like, not since then had consumers been predicting one-year inflation to be 6.7%. So it's a really strong signal for how the market has become a little bit less vulnerable to liquidity shocks like this and to movements. And now that treasuries, U.S. treasuries, are sort of more of a chess piece and a overall safe haven, we think it's going to be really strong for the adoption story. So that helps us. It's been a soft quarter. So coming out of that, we feel there's a lot of tailwinds for the support case for crypto assets.
Yeah, and what's interesting, Eran, is it's still within its adolescence. This is a young asset class, and we're kind of learning as we go along as it builds up its institutional presence and how it's going to react to these macro environments.
Definitely. I mean, if you think about crypto and blockchain as a whole, it kind of really started with Bitcoin in 2009. And it's still viewed as a somewhat of a risky asset. So as capital, as Andy was pointing out, as capital moves into this market, they're first looking at the most least volatile asset, which is Bitcoin, and then kind of gradually moves around to the other kind of alt assets. But what I think is going to happen as we progress is people will appreciate the utility and the other elements that this technology could bring, and we're going to see actual capital moving in, not just for investment, but for actual using the technology for its purposes.
Yeah, I think that's a good point that Eran makes around utility and how it's going to become ubiquitous when you think about how the digital capital markets evolve.
Yeah, in fact, the whole utility of crypto is going to be adopted from a much bigger level with regulatory clarity going forward, right? Because the underlying technology will be built into the crypto rails or the financial rails that'll feed into this entire ecosystem. But just going back to the Bitcoin argument there. We all know from a longer-term narrative that Bitcoin is a store of value. It's on its journey there. It's not quite there yet, and a lot has to do with the fragmented liquidity globally. But it's interesting to know during this time of stress, Bitcoin also adopts a sort of flight to safety narrative, and it's only in certain windows that happens. And right now is the current window where it's actually adopting that narrative. I mean, think about it: the bond market sold off. Equity market sold off, and Bitcoin on a relative basis kind of just at least bounced back or outperformed all the other asset classes. We saw this once before. If you remember March 2023 with the banking crisis, both Silicon Valley, etc., Bitcoin rallied 40% because it was a time of stress. So when you have these scenarios where there's a distrust of the systems, Bitcoin kind of shines in that environment as well.
Yeah.
So it's bouncing around different sort of narratives, and this is the narrative right now.
Yeah, well, I mean, Andy, again, going back to the adolescent theme here, is it too young to behave like a traditional,
both great points,
right?
No, I think the point here was that Bitcoin is the quality asset within the asset class, so you're going to rush out of other more speculative things into your base currency, which might be Bitcoin. So it can be flight to quality within crypto. But your point is bang on. Like with the trust difference last week was that U.S. Treasuries were no longer the safe place to go, right? They became the chess piece in this giant kind of trade war drama. And therefore, where are you going to go? Now, I don't think people raced into Bitcoin, but people didn't race away from Bitcoin. Yeah. So it wasn't a liquidity vacuum. So in those combination of circumstances, you add to the store of value, you really get the safe haven and flight to quality aspects. So it was very reassuring to hear that. And then when those Michigan numbers came out and you think, gosh, this really goes back to Bitcoin's core narrative of an alternative place to store value while other parts of the market are experiencing, medium to long-term tumult. Yeah. And then you think about the trading environment, the infrastructure that's building around the industry, right? Between institutional trading and ideas about what institutional traders and banks need to serve customers better. It's been a slow burn this year, I'll admit it. We've had a very, very soft first quarter, but the future looks like the build, regulatory, and industrial build is moving along quite nicely.
Yeah, but Eran, I want to address the issue while we get regulatory framework, what's also going to benefit the institutions? You have to think about the privacy aspect as well with the underlying technology. Banks are not going to be so quick to give some of that data away.
For sure. I mean, we look at the technology and provides so much promise. Immutability, the ability to kind of keep on building and have the trust that is not just paper, is through smart contract or technology. But having all your business out in the open is not something that is commensurate with actual business in the real world. Everything in life has both a public and a private side. Businesses need to have a selective disclosure on what they want to expose and what not. Blockchain as a technology and crypto as an industry needs to evolve to allow for that level of discretion. And then we're going to see a shift of actual kind of business into this space.
Yeah, well, I mean, it's a compliance issue as well when you think about financial services and how we're regulated.
Yeah, no, and just to jump on that point, I mean, if you really zoom out in 2025, just get rid of all the tariff noise, get all the market noise. I mean, what's going to happen this year? Regulatory clarity, which is going to lead to maturity of market structure. It's going to lead to more infrastructure development. Privacy is going to be a part of all that. You can develop financial primitives on chain. All that is going to happen. All that's going to pave the way for development of the industry. And then what's going to happen is that right now in crypto, the liquidity within crypto is so fragmented globally. All that's going to shift to the U.S. and any sort of regulated environment that wherever you have that regulated environment. So very simple example is as an example, the Bitcoin ETFs were launched, right? Mm-hmm. The option market on those ETFs is now like 50% of what Deribit trades on a daily basis. Deribit is 90% of the global offshore options market, and that has shifted to the U.S. And obviously you have the whole ecosystem developing around that. First quarter, CME futures on Bitcoin, record volumes. So all of that you can anticipate once there's regulatory clarity and infrastructure that develops around it. All the liquidity is going to be shifting.
Yeah, it's potentially shifting to the U.S. I mean, the previous administration, absentee of regulatory framework and clarity, kind of made businesses not want to get into the game. It's now the rails, whether it's the stablecoin bill or the market structure bill, that is going to provide the clarity, reduce the risk, and then we're going to see a change in the market.
Yep.
Which I think, Andy, you and I have spoken about this nearly every time we're on together. It's not necessarily the product that is exciting to me. It's once you get over those regulatory hurdles and understand how to operate right within this framework, that's the catalyst. Because once you have the U.S. on board, now you're talking scale.
Absolutely. I kind of like both ways, right? I like being able to trade options on ETFs and use a U.S. bank and use that liquidity. I also like the fact that out in retail and APAC, people can just climb on a centralized exchange or a DeFi exchange and do that thing as well. I think you kind of want to have a bridge where the two can scale and more capital can flood into the asset class into and outward safely. It would be a shame if all of crypto's original promise of trustlessness and statelessness was lost there, right? We like the idea of private blockchains that protect privacy. We like the idea of public blockchains that maintain their original kind of cause. Right. So I can see a best of both, right? The United States, those who don't want to completely on-chain themselves in the United States will be able to inject a lot of liquidity in the options is a great example of that. obviously people who want to maintain privacy and yet commit to banking services will inject. That will help the whole asset class. Will the US end up owning all of it? I kind of hope not. I kind of hope we still get some crypto nativeness which benefits from that liquidity. But in any case, all of these things are moving in the right direction.
Yeah, I guess, Eran, what I'm struggling with is you can't, from a privacy perspective, have best of both worlds. You won't be able to operate in the EU, as an example. You won't be able to operate in Colorado or California unless you could comply to privacy laws.
Indeed. I mean, today's blockchains are completely public. If we look at GDPR, just as an example, the right to be forgotten, you cannot comply with a technology that is completely public and never forgets.
Right.
You have Bank Secrecy Act. You got HIPAA that wants to put kind of medical applications on chain. We got to be able to evolve this technology to a place where we can both be regulatory compliant and provide the privacy and the other decentralized elements that we're looking for. It's inevitable we'll move into that direction.
Yeah, which is so interesting because there's always been this argument, well, if we can make it look like traditional infrastructure and we already have those rules into place, why can't we plug and play them? Well, these are the fundamental reasons why that doesn't necessarily, you can't square that round peg, you know?
Yeah, absolutely. And listen, the applications are endless in terms of that privacy layer. I mean, think about all the sort of what happens in the background when you move collateral, when you when you lend out your securities, when you share customer data, when you face a liquidation event or a default. You don't want that being publicized to the market. So this privacy layer in a form that can work is absolutely essential.
Yeah. Well, I think we also think of digital assets in terms of store of value or hedging or digital gold and so forth. But the fact of the matter, there are other areas of the world, you have a couple billion people that are using it to grow microeconomies that don't have traditional financing in place and raising alternative forms of capital. Right. I mean, this infrastructure is being utilized, to your point. This is the utility in a number of areas of the world.
Exactly. I mean, the whole infrastructure is being used for capital formation. There are new ways of raising capital through crypto. Making the whole sort of operational process more efficient, reducing a whole sort of middle layer of costs that you normally would have to just incur, and it hits the bottom line. So this whole crypto infrastructure just it's not just a capital formation through tokens, but just the underlying technology makes everything a little bit more efficient.
Yeah.
Yes. But there is kind of a generational evolution. So if you think of Bitcoin as the first generation, it's store of value, it doesn't have yield. So actually when that will come about, and there are some projects in the work to make that happen, there's going to be a lot of inflow of capital into Bitcoin. Ethereum was a second generation offering programmability, Cardano, Solana, and others, third generation with governance and other things. We are gradually learning on this technology and evolving and hopefully bringing the fourth generation that will unlock and bring TradFi into Web3. No more TradFi and DeFi, right. Just Fi.
Yeah, well, I mean, that was a big theme at Consensus, right? Felt like last year in 2024, where it was capital markets and integration and learning how to have the nimbleness of the tech ethos and the scalability of the banks. It was a big love fest in that respect.
I wish the love fest was being felt by U.S. investors, because I think what we need to do a better job of as an indexing company, right, even not as a manager, is to make sure that those growth cases are put alongside Bitcoin's investment case as reasons to be in the asset class. I think if you look at Ethereum ETF uptake, it reflects this kind of sticking point that people think about blockchain technology. They can't really touch it. They don't think about things like privacy or being able to harbor $250 billion of stable coins or tokenize this or tokenize that. I think that messaging really needs to get through to investors so that they understand, I own Bitcoin because I would rather own it than the other part of its trading equation, US dollars right now. Right. But for layer one blockchains or for infrastructure providers for DeFi, I think there's growth there. There's capital formation. I want to be a part of that. The more people can really just get their heads around that, of course, we like them to do that at the index level, the more they'll be able to participate.
Yeah, and you were talking about the evolution of these assets just before. I mean, we saw that in TradFi, right? I mean, the internet looks very different now than it did in the mid-90s.
Yeah, for sure. Well, Andy's talking about people kind of participating. So there are obviously investors. They're looking at technology, looking at investment. For end users, they wouldn't know. When I use an application today,
Absolutely right.
I don't know where it's being hosted, how it's being kind of performed. I just use it. And I honestly don't care how it's being implemented. We will get to a place where DeFi and applications are just part of the infrastructure that powers what we do, and we'll get the benefits, but we won't really realize what's under the hood.
Yeah, so I mean,
And that's the beauty of it, right? The whole
Yep.
programmability thesis around it. You can be just sitting on the token on a stable coin earning yield because on the background, smart contracts that generate that yield. These are new financial primitives that are just going to, have a tremendous growth once the regulatory framework is.
right, but it makes you wonder, what is that point of ubiquity, right? When do we realize we're using it and getting from A to B and not even being aware of it?
Right.
I mean, how many years does that take? What is the project? What's the benchmark to, not to take an indice?
But what's the benchmark? It's true. You want to turn the faucet and water starts coming out. You want to flip the switch and the light goes on. You're like, hey, that's great. I don't know how that's happening, but it's happening. I take it for granted. I'm glad it's there. It's so early. It feels like we always do this from this building like 25 years ago when QQQ started. People couldn't name the technologies in the bottom half of the QQQ, but they knew that they were there and they knew that winners would float to the top. We're still in that phase. I think people have to dig into that. Pricing this year so far, especially after the inauguration, has been super soft. And that I think makes people feel like, wait a minute, what's happening here? Ether's down more than 50% from its high. So what's going on with that? Is this growth momentum we saw right after the election gone? It's taking a pause. There's a bit of uncertainty there. When Bitcoin starts to rally away with this new economic information and stability, I think the others will catch up. So we're not too worried about it. Medium to long-term investors should really think about that capital formation, really think about that infrastructure that makes the light go on when you flip the switch, that you may not understand what's going on behind, and just learn about the space. Don't pick individual tokens because you might not get it right. Don't try to time because you may not get it right. Just allocate to the asset class.
But even having said that, I feel like we're entering an environment where there's going to be a distinction between tokens, right? So there is an investment thesis, and I feel that's where TradFi and crypto will converge, because the whole investment thesis and asset management, practice and traditional finance will apply here as well.
Sure.
It's going to be all about cash flows with tokens. Going to be all about valuation. How much revenues and fees tokens generate. All of a sudden, you'll see a dispersion between all the sort of hundreds and thousands of tokens, that are out there. I mean, 99% are going to bleed to death, essentially, because you'll be able to distinguish. Okay, this is a token. It's a lending protocol. Generates this much revenue to cash. How do I value this on traditional metrics? Okay, based on the traditional metrics, even at that price, is it undervalued or is it overvalued? And all these assets coming from TradFi, which is a new pool of capital, because right now all you have is capital within crypto. Once you have new capital coming in, that capital is very sort of discerning. Okay, that capital is going to be value, no value, right? And that's also part of capital formation as well. Where is the money going to flow?
Right, which is interesting because I put on my fundamental equity hat for a moment when Andy was talking about the run that we saw after the inauguration. It makes sense to pull back from there from a valuation perspective because of the run that it had. And I think that's what investors are trying to figure out. What are the fundamentals? What am I looking for to establish that this is a better investment than this one on a relative basis, as an example?
I think once we start seeing real world use cases, people will get the confidence that this thing is to stay and to grow. Real world assets is one great example that is now being very hot in the market about moving in some real world assets and tokenizing them on chain, enabling us to create new use cases, new derivatives that don't exist in the outside world. Once we see that, and it's coming, I think we're going to see a shift in the market.
All right, appreciate everyone's insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.